Okay, so this is the fourth and last part of chapter number 13, interest rate derivative instruments, and we will talk about interest rate caps and floors. These are the agreements between the two parties where one party pays the other party for a specific time period if the reference rate is different from the predetermined level. So, if one party agrees to pay the other party if the reference rate exceeds the predetermined level, the agreement is referred to as interest rate cap or ceiling. Uh, uh, Alternatively, if one party agrees to pay the other when the reference rate falls below a predetermined level, it is called the interest rate floor. The predetermined level is called the strike rate, and the strike rate for a cap is called the cap rate, and strike rate for the floor is called the floor rate. The terms of the cap and floor agreement include a reference rate. So whether we are talking about a 3-month LIBOR or something else, the strike rate, cap or floor rate that sets the ceiling for the floor. So let's suppose the strike rate is 6%. The length of the agreement, let's say it's 4 years. The frequency of the settlement, it is settled, let's say, every 3 months. And the notional principal, the amount which will be used to decide the amount. So then let's say notional principal is 20 million, right? Okay, so if this is the agreement we are talking about, now every 3 months for the next 4 years, a party, let's say party D, will pay C whenever 3-month LIBOR exceeds 6 months at the settlement date. So, which means it's a interest rate cap agreement, right? The payment will be equal to the dollar value of the difference between the 3-month LIBOR and the 6% times the notional principal and divided by 4. We divide by 4 because it's a quarterly. So for example, if the 3-month rate is, let's say, 8%, so the difference is 2%, 8% minus 6%, 2% of 20 divided by 20 million, 2% of 20 million will be 400,000, and divided by 4, you will get 100,000, right? So party D will pay party C 100,000. In the case of the interest rate floor, it will be reverse. So let's say the LIBOR is now 8%, and okay, let's say the in this case, if the 3-month LIBOR is 8% and C receives nothing from D, but if the 3-month LIBOR is 6%, then D compensates C for that difference again, right? Okay. The risk return characteristics. The risk return characteristics of these caps and floor is straightforward. In an interest rate agreement, the buyer pays an upfront fee which represents the maximum amount that the buyer can lose and the maximum amount the seller or writer can gain. So the one who is securing himself against the interest rate will be paying some premium, and the writer will get that. The only party that is required to perform is the seller of the interest rate agreement. The buyer of the interest rate cap benefits if the reference rate rises above the strike rate because the seller must compensate the buyer. The buyer of interest rate floor benefits if the interest rate falls below. The seller of interest rate cap floors does not face counterparty risk once the buyer pays the fee. In contrast, the buyer faces the counterparty risk. How we can interpret the cap and floor position. In interest rate cap and floor, the buyer pays an upfront fee, which represents the maximum amount that the buyer can lose and the maximum amount that the seller of the agreement can gain. The only party that is required to perform is seller. The buyer of an interest rate cap benefits if the reference rate rises above the strike rate because the seller must compensate the buyer, and the buyer of an interest rate floor benefits if the reference rate falls below the strike rate, right? So keeping these in mind, how can we better understand interest rate caps and interest rate floor? In essence, these contracts are a package of interest rate options at different time periods. As with a swap, a complex contracts can be seen a package of basic contracts, options in this case of caps and floors. Each of the interest rate options comprising a cap are called caplets. Similarly, each of the interest rate option comprising floors is called floorlets. The question is, what type of package of options is a cap and floor? Note the following very carefully. It depends on whether the underlying is a rate or a fixed income instrument. If the underlying is considered as a fixed income instrument, its value changes inversely with the interest rate. Therefore, for a call option on fixed income instrument, interest rate increase, fixed income instruments price decrease, call option value decreases, and interest rate decrease, fixed income instruments value increases, and call option value increases. For a put option, interest rate increase, fixed income instrument price decrease, and put option value increase, and interest rate increase, fixed income instrument price increase, and put option value decrease. Right? To summarize the situation, if you are a long call, when interest rate increase, your value will decrease, and if it decrease, your value will increase. But if you are a short call, it's vice versa. For a long put, it's increase, decrease, and then short put, increase, decrease. The cap and flow, the situation is similar. So if you are a short cap, so the short cap is equivalent to a long call. So if you are a short cap, so short cap is equivalent to a long call, right? Therefore, buying a cap, long cap is equivalent to buying a package of puts on a fixed income instrument, right? So buying a cap, so if you are a long cap is equivalent to buying a package of puts on fixed income instrument, and buying a floor is equivalent to buying a package of calls on fixed income instrument. Caps and floors can also has been package of option on interest rates. In other words, over the counter markets, one can purchase an option on interest rate. These options work as follows. In terms of their payoff, there is a strike rate. For a call option on an interest rate, there is a payoff if the reference rate is greater than the strike rate. This means that when interest rate increases, the call option value increases, and when interest rate decreases, call option value decreases, as can be seen from the payoff for cap and floor summarized above. This is payoff of a long cap. Consequently, a cap is equivalent to a package of call options on an interest rate. For a put option on interest rate, there is a payoff when the reference rate is less than the strike rate. When interest rate increases, the value of the put option on an interest rate decreases, as does the value of a long floor option when interest rate decrease. So the floor and puts can be thought of a option on a fixed income instrument or option on a interest rates. Creation of an interest rate collar. It's an interesting concept. Interest rate caps and floors can be combined to create an interest rate collar. This is done by buying an interest rate cap and selling an interest rate floor. The purchase of the cap sets a maximum interest rate that the borrower would have to pay if the reference rate rises. The sale of the floor sets the minimum interest rate the buyer can benefit from if interest rate declines. For example, consider that you purchased with a strike, you purchased a cap with a strike price of 7% and a floor with a strike price of 4%. If the reference rate exceeds 7%, the borrower receives payment. If the refund rate is less than 4%, the borrower makes a payment. Thus, the borrower cost will have a range of 4 to 7%. Note, however, that the borrower's effective cost is adjusted by the premium he must pay for these contracts. That's all.